Okay, now we move on to our next topic, the evaluation of financial performance. All right, first of all, we have to know what is the financial analysis. So financial analysis is actually the assessment of the firm's past, present, and anticipated for the future performance. So what we are going to do is to assess the past, present, and we would like to estimate for the future. All right, the next one, number 2, is analysis is based on the firm's financial statement. It based on the financial statement that we do. All right, so that one, based on that financial statement, we are going to analyze. So this one will focus on the historical performance to estimate for the future performance. So based on historical, now we are going to predict for our future. And this one, number 4, is going to allow the comparison of the company's performance over time as well as the performance over relative to its competitors. So it means that here we have to, number 1, we have to, we can compare over time, some sort like the current year with the previous year, or we can compare the company or company A with the company B. Alright, so what are the objectives of financial analysis? So number 1 is to identify the firm's strength and also the weaknesses. So if we do this kind of evaluation of performance, so we can see their strength and weaknesses. Alright, next one, the company can capitalize this strength and to take remedial and corrective action to improve for the weaknesses. So we have the two. We can use the capitalize for the strength, and also we can also take the corrective action. Alright, so the financial ratios, what is financial ratios? Is actually the mathematical aids for evaluation or comparison of the financial performance. So we are going to use the figures and the calculation. So number 2, we are going to look at the relationship between individual values and also relate them to how a company has performed in the past and might perform in the future. So we have to know the relationship, how are going to relate with the past performance and also for the future performance. Alright, number 3 is standardized financial information to facilitate the meaningful comparison. So since the financial information what we have in the financial statement is standardized, so it's really for easy for us to make a comparison because we have the standardized format. Alright, objective of the ratio analysis, number 1 is standardized financial information for comparison. Right, number 2, we would like to evaluate the firm's current operation, how it works, and then the performance of the company. And then we would like to compare the present performance with the past performance, which is the current year compared with the previous year. And then what we can compare also, we can compare the performance of the firms with other firms or industries. So for example, company A, we can compare with the company B. If company A is in the tourism sector, so we can see the performance of company A in the tourism sector. Alright, number 5 is assess the efficiency of the operation. So we can see how efficient the company is doing in managing their operation. And then we also can assess the risk of the operation. Alright, so type of comparison, we have two, internal and external. So what is internal comparison? So what we have to do is we analyze based on the comparison of the similar ratio for the same firm but at the different period. So it means that only company A, but what the difference is current year with the previous year. So this is what we call time series analysis. Why we compare the same company but with at the two different time. What about the external comparison? So external comparison is actually we compare the firm ratios with other firms, similar industry. So it means that suppose we have to compare with the same industry, just like what I mentioned earlier, industry in tourism should be compared in the tourism industry, cannot be compared with the manufacturing. So this one what we call is interfirm or cross-sectional analysis. Alright, so these are the uses of the financial statement. Number one is the shareholders. Of course, they are the shareholders of the company, the managers, the creditors, the current and the future employees. Of course, they are interested to know the performance of the company. And then prospective investor, either they would like to invest or not to invest in the company, and also the customers. Customers have to see whether the company is established or not, and also the government are also very interested for tax purposes. All right, so basically we are going to know the various type of ratios, so we have to concentrate into 5. The first one is liquidity, efficiency, leverage, profitability, and market ratios. Alright, number one, we move on into liquidity ratios. Please be remember, so we have 5 categories. So this is number one. So liquidity ratio is how liquid. So this one is we are going to show the firm's ability to meet its short-term obligation. So it means that are they able to pay their obligation or debt within for a short-term period. For example, two commonly used liquidity ratios, which is current ratio and quick ratio, or the other name we call it as a acid test ratio. So what will be the formula is current ratio equals to current asset divided by current liability. So it indicates the extent which current liability are covered by the current asset. So it's here current asset divided by current liability. We would like to see whether this current asset is enough to cover for the current liability. Alright, so number 4, the current ratio of 2 times means that the firm has 2 ringgit in the current asset for every 1 ringgit of the current liability. For example, current asset divided by current liability, if the answer is 2:1, so 2 here refers to the current asset. So we have 2 ringgit of current asset in order to pay for 1 ringgit of current liability. So it indicates that the firm has no problem paying its current obligation on time. Alright, so the other ratio is actually 2 times, cannot be applied to all companies. So it depends on the company. So different types of the industry have different types of asset requirement and have different proportion of the current asset and the current liability. So it means that the good is 2 times, but it's not applicable to all of the industry too. So we have to look into detail. Alright, it is most commonly used to measure the short-term solvency. So it means that they have enough cash or not to pay for their short-term liability. Alright, so number 7, one drawback of the current ratio is that inventory may be included as part of the items that are difficult to liquidate quickly and have uncertain liquidation values. And of course, the total of current asset is including our inventory or stock. So stock here is quite difficult to transfer to cash immediately if the company need cash urgently. Alright, number 8, so we have the alternative measure of liquidity to use, which is called as a quick ratio or acid test ratio. So the quick ratio is actually we have to minus with inventory and prepayments. So these 2 items is quite difficult for the company to transfer into cash. So we have to minus these 2 items. So we get the net current asset, we divide by net current liability. So the quick ratio indicates whether a firm has enough current asset to cover current liability without selling their inventory. As we know, prepayment means that we overpaid to someone. It's quite difficult to get back our money. Alright, now we move on to number 11. So inventory is deducted because it is generally take a longer time to convert into cash. It's quite difficult for us to sell our stock immediately. So prepaid expenses also deducted because there are expenses that the firm has paid in advance and cannot be used to pay obligation when they become due. For example, we overpaid to our expenses. For example, we have made extra cash for our extra pay for our electricity. It's quite difficult to use the extra money that we pay to pay something else. So companies with quick ratio of less than 1 will not be able to pay its immediate obligation, and therefore should be looked with caution. So it means that here, if our current asset minus inventory minus prepayment divided by current liability, if we got 1:1, if we got less than 1, it's quite difficult for them to transfer into cash. Alright, causes for the liquidity problem. So what will be difficult for them to transfer to cash, or it is very difficult for them to have enough cash? Number one, if they are holding too much stock. So it means that it's quite difficult stock to transfer, stock inventory to transfer to cash. And then they have a poor debtors collection system or poor account receivable collection system. So it means that here you have a money, but then the debtors do not paying you back, and then your collection system is not too good. It's quite difficult for you to get back your money. And then number 3 is poor cash management. So it's quite difficult for you also, because you are not able to manage your cash properly. And number 4, company is using a short-term sources of financing to finance a purchase of long-term asset. For example, here they use short-term loan, which is they borrow loan less than a year in order to pay for their long-term asset. For example, if they borrow money or for a short term from the bank in order to pay for the building. Building normally we do for a long-term financing, but here this one they use the short-term financing to pay for the long-term asset. Alright, so suggestion to improve the liquidity position. Number 1, we have to promote cash sales. Why cash sales? Easy for them to get cash, and then give discount to make sure that we can make more sales. And at number 3, give discount to encourage for early payment. If they pay earlier, then you give more discount. And then improve collection system to make sure that you can collect back your money. And then adapt effective stock control to ensure that you don't hold an excessive or larger stock that you really don't need. And then number 6, invest in marketable securities to earn income. So it means that you can invest in a short term. It's easy for you to transfer to cash if you really need money. And then you have to reduce your current liability by paying off the existing creditors. Use long-term sources of financing. So it means that here, if you have a current liability, what you have to do is try to get for a long-term or long-term financing. You borrow more than a year in order to pay for the short-term. So this is what we call less risk. And then number 8, you adopt hedging principles in financing, that the firm asset, temporary asset, use short-term, permanent asset, use long-term financing. So hedging, it means that equal. For the short-term financing is used to finance the short-term asset, and the long-term financing is used to finance the long-term asset. Okay. Alright, next one, efficiency ratio. So what is efficiency ratio? So this one also is called as the management ratio or asset utilization ratios. Alright, so this one we are going to measure how effective a firm in managing its asset in generating sales. So we are going to see how effective the company in managing their money in order to generate sales. Okay. Alright, also show the firm's efficiency in collecting debt as well as turning its stock into sales. Alright, we are going to see how fast they can use their sales in order to get more income. All right, or how efficient they use their stock in order to generate more sales. All right, so we have four here: inventory turnover ratio, average collection period, fixed asset or non-current asset turnover, or the last one, and the last one is total asset turnover. So number one is inventory turnover ratio. What we have to here is a cost of goods sold. We divide by average stock or closing stock. If we have the opening stock and closing stock, then we can take the average. If we don't have the average, then we just take the closing stock or closing inventory. So this one indicate how many times the stock is sold and replaced in a year. So here, so we divide by average stock, so we can see how many times that the stock is sold and replaced. So it means that here, number three, the higher the ratio, it shows that the faster the stock is being sold. So it means that here the higher the ratio is good for the company. So inventory turnover ratio can be expressed in terms of number of days and referred as to the inventory conversion period. So it can be calculated by dividing 360 days by the inventory turnover. For example, here inventory turnover shows that 6 times. So it means that in 1 year, so the stock is replaced 6 times. Right, so means that inventory conversion period of 360 days, we divide by 6. So it means that every 60 days. So 6 times in a year means that every 60 days or every 2 months the stock has been replenished. So it implies that is a firm able to sell inventories within 60 days. Alright, possible causes for poor inventory turnover, or it means that the slow moving item of the stock, why the stock is slow moving. Alright, number one is the company is holding too much stock or overstocking. Alright, so it's not good for a company. Why? Alright, because if they have much stock in the store, shows that they have to put more money in order buying stock. Alright, large proportion of stock consists of old and obsolete stock. So it means that maybe they become damaged more than the expired date and so on. So the damaged stock which may be result a poor stock control system. So if you have too much stock, this one is not good. It can be obsolete or damaged. And then lack of promotion, so it means that here why your sales is less. And then the firm do not provide the trade discount to encourage bulk purchase. So it means that here if they buy more, then you should give more discount. The firm pricing policy which affect the demand of the firm's product. So this one also, the pricing policy also will be taken into consideration. Why? It will give the big impact. Alright, so these are the suggestions how to improve the inventory turnover. So it means that we are going to inventory turnover, we would like to have a higher numbers, and also the number of days should be reduced. Alright, if the companies is overstocking or they have more stock, or evaluate the stock control system and introduce a more effective system, or change its present method of ordering stock. Maybe they are ordered too much, so we have to look back on the stock system, controlling system, whether they buy too much or what. And then what they have to do is cut down on slow moving stock. So it means that here if the slow moving item or the sales of the stock is less, so you don't have to purchase more from the supplier, because why? It's going to be obsolete. Alright, and then number three, you have to determine degree of competition, whether the product elastic or not. Alright, so we have to see also the price of the product, whether it's really competitive with other or not. Alright, average collection period. So here we call it as a day sales outstanding, DSO, or the number of days taken by the firm to collect its account receivable. We would like to see how long the company take in order to collect back their money when they make sales. Alright, reflect the company's credit policy, whether they are loose or strict. So we have to see here whether loose or strict. So we have to analyze, and then we have to tighten the credit policy. Alright, shows the firm effectiveness and efficiency in collecting debt. If the collecting debt is not good, shows that they are not able to collect their debt. The shorter the average collection period is more efficient. Why? Because you can collect back your money immediately. Alright, so it may also indicate the company is operating on a cash basis. Average collection period. Average collection period equals to account receivable divided by annual credit sales, and then we times with 360 days. If the answer is equal to 40 days, means that the firm took 40 days to collect cash from their debtors. So it means that here 40 days from the day they're making sales, and then the time they collect back their money. It also can be expressed as a number of times and referred to the receivable turnover ratio. So how to get the receivable turnover ratio? So receivable turnover, we take 360 days, we divide by ACP, average collection period. If the answer is 4 times, it shows that here imply that the firm is able to collect its debt within 90 days. So how to get the 90 days is actually 360 divided by 4 equals to 90 days. Or if we 360 divide by 90, we got 4 times. Alright, possible causes of poor average collection period. Number 1 is lax or loose credit policy. So the policy is not good, so we have to tighten up our policy. And then poor screening at the first time if we would like to give the credit to a customer. We also have to see that one. Alright, number 3, no aging of customer's account. So we have to do this one to make sure that we are going to have the list of amount the customers owe to our company. Number 4, we also have to send reminders and follow up for the late payment. And then number 5, we do not give enough cash discount to encourage them to pay early. Alright, suggestion to shorten the average collection period. Why? The shorter the better. Number 1 is we have to adopt a tighter collection policy. We have to keep track to make sure that our debtor is going to pay us back. Alright, we have to prepare the aging of the debtors account. Make sure that we have to list down the amount that they owe to our company. Alright, the screen new customers before allowing them credit sales. So this one we have to look whether they are able to make their payment or not able to make payment. For those, if we can see that they are not able to make payment, so we do not grant a credit for them. Alright, offer cash discount. It means that to encourage them to make early payment. So if they buy more, then we give more discount. Alright, fixed asset or non-current asset turnover and the total asset turnover. So here we have fixed asset turnover or non-current asset turnover. So what will be the formula? Sales divided by net fixed asset or net non-current asset. This one is total asset turnover equals to sales divided by the total asset. So this is to measure what? To measure the firm's efficiency in utilizing its property, plant and equipment or their non-current asset in generating sales. So we have to see how efficient they are using their non-current asset in order to make sales. Alright, number 4, the higher the ratio indicates that the firm is generating higher volume of sales. with the given amount of assets. So higher ratio indicate good, higher value of sales. All right, a lower ratio than the industry shows that the company should increase its sales or dispose some of its assets. So it means that if they cannot generate more sales based on what they have spent in their non-current assets, so what they have to do, either they have to increase their sales or they have to dispose their some of their non-current asset, which is they really not really need for the asset. Right, possible causes of low fixed asset or non-current asset turnover and total asset turnover, and suggestions for the improvement. So number one, underutilization of the fixed asset or non-current asset may be due to much investment in the non-current asset. All right, and the current asset and inefficient use of this asset to produce sales. So it means that here they not use the maximum utilization of the non-current asset in order to produce sales, and also there is an insufficient sales. All right, suggestion for improvement. Number one, we have to increase production, and then the company should dispose of the idle non-current assets, so which they really do not need. What they have to do is they have to dispose, and also they have to review the selling price, the implement of aggressive sales promotion in order to make more sales, and also to give more trade discount. This is number three, leverage ratios. So what is leverage ratio? We call it as a debt management ratio or gearing ratio. Alright, so number two, measure the level of debt or borrowing in a firm. So this one we use a borrowed capital or loan. So it means that here how effective they use their loans in order efficiently use in the company. Are they managing their loans or their debt efficiently or effectively? Alright, number three is highlight the ability of the firm to pay its principal and interest charges. So we have to analyze whether they are able to pay back their loan or not. Alright, it comprises of three: debt ratio, debt to equity ratio, and time interest earned. Alright, so debt ratio equals to total debt divided by total asset. So this one we would like to measure how much debt is used to finance the firm's asset. We have to see the total debt that in order to finance our total asset. So both debt comprises of current liabilities and non-current liabilities. So creditors prefer low debt ratios because it reduces the potential loss that may occur in the event of liquidation. Alright, so number five, the owners may want to more leverage because it increased the earning. Right, a debt ratio of 55% means that the creditors have supplied more than half the firm's total financing. Alright, so it shows that if 55%, it means that from the total of the asset, the 55% is come from debt. So if a company debt ratio is significantly higher than industry ratio, it would experience that difficult in raising additional borrowing. So it means that if they really have a high borrowing, it's quite difficult for them to get more borrowing. Alright, so debt to equity ratio, so we take the total debt, we divide by total equity times 100. So this one we measure the percentage of borrowing used compared to the equity. Alright, this one is time interest earned, also called as the interest coverage. So ratio of this one equals to EBIT, or earnings before interest and tax, to the interest expenses. So we take the earnings before interest and tax, we divide by interest expense. So this one we measure the ability of the firms to meet its annual interest payment. We would like to see how much is their earning can cover for the interest. The higher the ratio shows that the firm's ability to fulfill or to pay for the interest obligation. Alright, possible causes of high leverage and suggestion for the improvement. Number one, high borrowing is actually due to high dividend policy. So what are the suggestion is we have to review the dividend policy, and then we have to finance capital investment from retained earnings. So it means that here we do not borrow, but we use our retained earnings in order to finance our project. All right, and then number 3, have the optimum mixture in its sources of financing. So it's a sources of financing. It should come from debt, loan, and also shares. All right, for profitability ratios, so this one we are going to measure the effective of the firm use its asset to make profit. Okay, so we would like to see how effective they are. All right, so shows the combined effect of liquidity, asset management, debt management on operating result. So also indicate that firms' efficiency in controlling costs and the pricing policy of the firm. So we would like to see how profit of the company is. All right, it shows the profit earned for every RM of sales made, or the profit earns per RM of investment in the asset. So we have 5: gross profit margin, operating profit margin, net profit margin, return on asset, and return on equity. All right, gross profit margin, we are going to measure the gross profit earned on sales. So our formula will be sales minus cost of goods sold, and then we divide by sales. All right, gross profit margin is actually percentage of sales remaining after deducting the cost of sales. So if the answer get 30%, means that the company making 30 cent gross profit for every 1 ringgit of sales made. So 30%, it means that 30 cent of 1 ringgit is actually gross profit. A high gross profit reflect the good earning potential. It also shows that the efficiency of the company in controlling its costs, cost of goods sold, and the pricing policy implemented. So we would like to see how is actually they are making profit for this one. Alright, possible causes of low gross profit margin and suggestion for improvement. Number 1 is sufficient sales volume due to high selling price or higher cost of goods sold. So number 1, there are less sales. So it means that they have to increase their sales. And number 2, they have to look on the cost of goods sold. Alright, if they can reduce the cost of goods sold, then the gross profit margin will increase. Higher cost of goods sold may be due to expensive sources in supply of goods, higher labor costs, and higher production wastage. Alright, suggestion. So what you have to do is review the pricing policy. We have to see whether the price is too high or not, and then reduce the cost of goods sold by changing supplier. So this one we can see whether we can get offer from other supplier, and then reduce labor costs and production wastage. So this one we can reduce. If we can reduce, then we can increase our gross profit margin. All right, next is our operating profit margin. So operating of profit is actually refers to the earning before interest and tax, or we name it as a EBIT. So percentage of sales remaining after deducting all costs and expenses, but this one exclude interest and tax. So operating profit margin equals to earnings before interest and tax divided by sales. The higher the operating profit margin, the higher the profitability of the company. Alright, so these are the possible causes of lower operating margin and suggestion for improvement. So causes because of lower profit margin, and then because of the high operating expenses, and because of the lower selling price. So this one will give impact to the operating margin. So what we have to do, we have to reduce cost of goods sold, reduce operating costs, and also we have to review our selling price. All right, net profit margin. So net profit margin equal to net income available to common shareholders or ordinary shareholders divided by sales. So this one, net income available common to shareholders, refers to the net profit after tax minus preferred dividend. So this is no preference shares. The net income available to common shareholders is equal to the net income after tax. So this one, preference shares or preferred dividend, is not counted. Alright, so this one we have to minus with our profit, should be minus with preferred dividend. Alright, causes of low net profit margin and suggestion for improvement. So the reason, because we have high operating expenses and high interest charge. So what we have to do is to reduce our operating expenses and review our financing strategies. Alright, so return on asset is also known as return on investment. So it indicates the management ability to make profit from the firm's investment in assets. So our formula, ROA or return on asset, equals to net income available to common shareholders or ordinary shareholders. We divide by the total asset. Return on equity measure the profit earned by the common shareholders from their investment in the company. The higher the ROE or return on equity, it shows that the better the return for the shareholders. Alright, so ROE, same also, the net income available to common shareholders, but we divide by common equity. So common equity will include retained earnings, share premium, and ordinary shareholders. So this one, the combination. If someone said what is the common equity, so common equity inclusive of retained earnings, share premium, and ordinary shares. Right, so this one is market ratios. So our last one, number 5, market ratio. So what is market ratio? Is also named as the investor ratio. So relate to the firm's stock prices to its earning and book value per share. It indicates that investor think that the company past performance and also for the future prospect. So this one is going to also to measure the investor's perception and judgment towards the firm growth potential. So we have 5 categories here: earnings per share, dividend per share, dividend payout ratio, price earning ratio, and dividend yield. Right, now we are going to have here EPS. So what is EPS? Indicate that profit earned for every unit issued share. So the formula is equals to net income available to common shareholder, and then we divide by number of ordinary shares issued. A higher value indicate higher profit per share. Alright, dividend per share, it indicates the amount of dividend received by ordinary shareholders for each unit of share. So it means that here for one share, what is actually dividend that you are going to receive for one share. So we take dividend divide by the number of ordinary shares. Alright, dividend payout ratio. So indicates the proportion of the earning that is distributed as dividends to shareholders. Alright, so we would like to see the portion of the earnings that we would like to give back to the shareholders. Alright, so dividend payout ratio for high growth companies are usually lower because most of the profit are spent on reinvestment and expansion. Alright, for the high growth companies, normally they have to reinvest back in order for the expansion. So the company will try to maintain a stable dividend payout ratio. So dividend payout ratio, so you take the dividend per share, EPS, we divide by earnings per share. So this is what we call a dividend payout ratio. So price earning ratio, PE, so compares the current market price with the earnings. So this one we would like to establish a stock is over or undervalued. If we would like to see the price is over or under, so we have to look at the price earnings ratio. So this one will show how much investors are willing to pay for the company's earning. Alright, measure the investors' confidence in the firm's future prospect. So what will be the formula of PE ratio? So market price per share, we divide by earnings per share. So dividend yield, to indicate to know the return earned on the share. So this compare the dividend per share received by the shareholders with the current market price. So what is the formula of dividend yield? So letters annual dividend, we divide by the current market price per share. So this is the common size ratio. So this one we call as a vertical analysis. So can be prepared both income statement and statement of financial position. So income statement is a profit or loss. Each of the item on the financial statement is calculated as a percentage of the total. So this one will allow the companies to compare performance from one period to another period, and also from a company to company, regardless of the size of the company. So we can make a comparison period to period, and also company to company. So to study trend with its own past financial statement. The objective to understand why changes have occurred and what to do in response. So what is a DuPont analysis? Is actually act as a search technique. So this is aimed at defining the key areas responsible for the firm's financial condition. And this is used to analyze the firm profitability and return on equity. So this one will allow the management to view more clearly so what determines or influence the ROE or return on equity, and the interrelationship between net profit margin, asset turnover, and debt ratio. So breaks into the ROE into three parts. That is profit margin, total assets turnover, and financial leverage. So here ROE equals to net profit margin times with the total asset turnover divide by 1 minus debt ratio, or equals to ROA divided by 1 minus debt ratio. So the other one, ROE, we can use this formula. ROA, return on asset times with total asset divided by total equity, and the other one is ROE equals to ROA, return on asset times with the equity multiplier. So this one, equity multiplier, we measure the firm's total asset per RM of the shareholders' equity. So how to get the equity multiplier? Equals to the total asset we divide by the total shareholders' equity. Alright, so this one will indicate how a company use debt in asset financing. Alright, so we have to see how they use debt in order to finance of their asset. A higher equity multiplier means that higher financial leverage. Alright, so how to improve the ROE or return on equity? Number one, we have to increase sales without this proportionate increase in cost and expenses. And then number two, we have to reduce cost of goods sold or reduce of the operating cost. Number three, we increase sales relative to the assets base, or we decrease the amount invested in the company asset. Number four, we increase the use of debt relative to equity, but only to the extent that it does not jeopardize the firm's financial position. We try to increase debt, which is related to the equity. And then advantages of DuPont analysis. So this one, we make it possible to assess all aspects of the firm's activities in order to isolate key areas of the responsibility. Number two, this one will allow management to view more clearly that derives the ROE, because we have to consider the three things earlier. Alright, provides management with a good map to follow in assessing their effectiveness in managing the firm resources as to maximize the return earned on the honest investment. So here are the limitation of the financial ratios that we use. Number one, if we make a comparison with the industry averages, so it's difficult for the conglomerates. Right. Number two, average performance as shows industry average maybe not be desirable. Alright, so even though this is the industry average, but there is the not the most desirable that we need. Alright, number three is because of the seasonal factors. So some seasonal factors will affect our ratios. And then because of the inflation also it will affect that. Number five, either the different operating and accounting procedures or practices also may make comparison difficult. Some sort like if they are using a different method of depreciation also, they will affect the profit of the company, and this one also will affect the ratios. Right, number six, it is sometimes difficult to conclude whether the ratio is good or bad, so we couldn't decide. Right. Number seven, it is difficult to conclude whether the firm's overall performance is good or bad because we have different categories. So maybe the profitability is good, the leverage is not good. So the overall conclusion is quite difficult for us to make. Thank you.